Well, good afternoon and welcome to our High Rock clients and any other listeners who have joined us this week. And thanks for taking the time to tune into our weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management, how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I am Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call, and I know that she's been working diligently on lots of wealth forecasts recently, so lots of new clients and lots of work for Bianca. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what happened over the course of the last week. Our overriding theme, as you all well know, for 2016 is that financial markets will remain volatile. January and February saw a spike in volatility, but markets settled thanks to the continued central bank's monetary stimulus. There is still a great deal of uncertainty in the world, and as we approach the end of May, there is little that has been resolved. The U.S. economy represents 20% of the global economy and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. At the moment, we see a growing chance of a recession in the U.S. in the next 6 months or so. Commodity prices, and especially oil, have been trending higher after a prolonged decline. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks considering their next steps. Central bank monetary policy has been at the heart of keeping volatility in financial markets lower. But now financial markets are becoming obsessed with the next moves by the U.S. Federal Reserve. Chances of a rate increase at the next FOMC meeting in June have risen. The catch-22 in all of this is that if the Fed raises rates because their goal is to normalize interest rates, they may push an already flattening yield curve flatter. And that may just be the catalyst that might tip the U.S. economy into recession. There are still lots of geopolitical wild cards, like the UK leaving the European Union, the U.S. presidential election campaign, the Middle East, Greece, Russia, China, North Korea, terrorist activity, and the refugee crisis. And any one of these that contributes a shock to the global economy could also be a catalyst for greater uncertainty. Bond markets provide the early warnings, and yield curve activity provides clues of timing and direction. So we'll talk a little bit more about that as we move forward today. After a fourth consecutive quarter of negative earnings growth, earnings expectations continue to be lowered for 2016, leaving current stock prices at relatively expensive levels. The trouble is that impatient investors continue to search for growth and are making equities a considerably more risky asset class. The period from 2009 to 2014 was a time of better than average returns for balanced and diversified portfolios. But the cycle of economic activity has slowed, and growth and inflation are no longer providing the returns that we had become used to. There is a tendency now for some investors and traders to pursue greater risk to improve their returns. We believe this to be a poor strategy. In fact, we believe that investor portfolios need to be revisited and allocations adjusted to ensure that strategies are providing appropriate risk-adjusted returns consistent with the current investing environment. Okay, well, let's have a look at what's been driving markets over the last week. Volatility has been trending a little higher recently, but is not anywhere near where we were at the beginning of the year and continues to remain well below its longer-term average. CNN Money's Fear and Greed Index hit a low near 9 in January, but now, while still in greed territory after the more stimulative central banks forced money out of low and negative yielding safe assets into riskier assets, it is starting to slip from its higher levels in the 70s last month. Markets moved rather quickly from oversold to overbought. In March, we believe that the next move is going to take us lower. Now, since our last webinar, our benchmark World Equity Index is up by 1% and is now up about 1% on the year thus far. The French CAC 40 index was the best performer since last Tuesday. The Canadian REIT Index was the worst performer. And the TSX has been the best performing country index in the developed world this year. The Canadian REIT Index has also done extremely well despite its performance last week. Now, we have an allocation to the REIT asset class in our global equity model, but we have recently done some rebalancing as it has done as well as it has. So it looks like our timing was pretty good here on that rebalancing to sell some of our exposure to Canadian REITs. Since the beginning of the downtrend in our benchmark all-country world index, there have been 2 periods of interim short-term rallies. In both cases, these rallies failed to make new highs, which signals that the longer-term downtrend channel has been reconfirmed, lower lows and lower highs. The next likely scenario will be to test buying support, and this could possibly take us to the bottom of that channel, which would be close to a 15% drop. The total return for this index, including dividends for the last year, has been a negative 7.67%, and the total 3-year return has been a positive 4.52%. And if you combine the equity and bond indices into a balanced scenario, the 1-year total return for our benchmarks has been a negative 3.4% for that 60% equity and 40% bond index combination. And over the 3-year period, it's been a positive 4.14%. For less risky 40% equity and 60% bond combination, the 1-year total return has been a negative 1.25% and a little under 4% for 3 years. Now, when you are comparing the return on your portfolio, don't forget to include your fees and MUR costs. U.S. bonds were lower this week, but high yield was up as investors moved into riskier assets again. Commodities were generally lower, led by gold. But the Bloomberg Commodity Index continues its new uptrend, but is off its recent highs. Our benchmark World Equity Index is comprised of, as I mentioned before, over 50% U.S. companies, so we keep a close eye on what's going on in the U.S. economy. But as we wait to see who becomes the next president, Clinton seems to have developed a fairly good lead at the moment, picking up about 8 points over the course of the last week. And of course, we're keeping a close eye on the U.S. Federal Reserve. Their April meeting, they indicated they were less worried about global economic issues, but they were somewhat concerned about slowing U.S. economic growth. Now, interestingly, we've had discussed this in the past few of our calls, but the past 3 recessions in the U.S. have followed on the heels of an increase in the unemployment rate that takes it through its 36-month or 3-year moving average. The rate of decline of the current 3-year moving average, currently at about 6%, is fast and quite steep, and if projected, could very well hit the 5% level in a matter of months. Even a slight uptick in the unemployment or in unemployment from its current level may indicate that a recession is imminent, especially if the U.S. Federal Reserve decides to raise interest rates. And I'll get to that more in just a moment. Well, U.S. second quarter GDP is still expected to show a growth rate of 2.5%, so there's been little change on that front from when we chatted last week. And elsewhere in the global economy, after all the monetary stimulus from the European Central Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, we continue to wait to see what impact they may have on the global economy. And as we go through each week, we have a broad and diversified benchmark equity index, which I've talked about, the All Country World Index we've talked about, and we'll continue to discuss as we go through our presentation today. It has close to 2,500 companies that are domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective. So we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. More than half of the companies are domiciled in the U.S., about 16% in Europe, about 7.5% in Japan, 6.5% in the U.K., about 3% in Canada, and about 2.5% in China. Well, the latest poll results show that the referendum to decide whether the UK will remain in the European Union, that poll to take place on June 23rd, has moved slightly better for the stay camp, and that's been helping the British pound recently. Into the euro area economy, year on year, we have seen the first quarter GDP expand an annualized 1.5%, down from 1.6% expansion in the previous quarter, but things are holding pretty much steady at this juncture, so no real signs of new growth coming. And after negative growth in the final quarter of 2015, the Japanese economy rebounded in the first quarter of 2016, but similarly has been unable to establish any momentum to the upside just yet. Here at home, tomorrow we'll get the Bank of Canada's take on the implications of the Fort McMurray wildfires on the Canadian economy as they announce their latest decision on interest rates. We'll be watching that closely tomorrow morning at about 10 o'clock a.m. when they release their latest information. The Canadian dollar got up to US 80 cents before retreating to 76 US cents as the wildfire problems exacerbated. Well, where do we see all of this taking us? Let's go see what the bond markets are telling us this week. Each week we do look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, UK, and Canada, should give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future inflation. But a flattening yield curve tends to signal a greater chance of recession in the future. The negative yields below that pink zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese yield curve, as we mention each week, is negative out to 15 years. And in essence, you pay to own the safety of Japanese government bonds, which seems kind of odd, as opposed to them paying you to borrow money, not anything or circumstances that we're really used to. However, it's not a very good sign for the Japanese economy going forward. Now, since last week, the U.S. yield curve has flattened, as increased expectations of a June Fed rate increase entered the market. Same with the UK, with better chances of the UK staying in the European Union. Canada followed the US, but spreads between the two countries have widened somewhat, and Germany saw a steeper yield curve. There's no change in the Japanese yield curve. And looking closer at the U.S. yield curve, which we will be doing on a regular basis, we do see that prior to the Great Recession of 2008-2009, the Fed pushed short-term interest rates up and flattened the yield curve. If the Fed raises rates, then we can expect similar circumstances to evolve. Short maturity bonds were higher over the last week, higher than were the longer dated maturities. That is a flattening yield curve and a predictor of potential future recession. So again, we will be keeping our eyes very closely on what's going on with that U.S. yield curve. Well, as for equity market value, when investors buy stocks, they buy a stream of future earnings. Now, the price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.3 times. The 12-month forward price-to-earnings ratio, so what we see coming in the future, is currently at an expensive 16.3 times. Now that is lower. Last week it was at 16.6, and at the equity market highs back in May of 2015 it was 17.1. But we're not really interested in buying stocks until that 12-month forward price-earnings ratio gets back to or below its 10-year average. And not only are prices expensive relative to earnings, but after the first quarter, there have been now 4 consecutive quarters of negative earnings growth, and expectations are that the second quarter will be the 5th consecutive quarter of negative earnings growth. And earnings growth for all of 2016 at the moment is expected to be less than 1%. So it is hard to expect growth in equity markets when companies cannot grow their earnings. And we talk about this on a regular basis, but corporate profitability, which is the white line that you see, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time around. So what does it all mean? Well, really no change in our strategy. Since last May, we have taken a cautious and defensive posture to investing, and in light of our key theme for 2016 of volatility, we remain defensive because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain on the sidelines. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe will add value to the long-term performance. Rebalancing on a regular basis is crucial, and we are constantly watching for rebalancing opportunities. Different asset classes will outperform or underperform at different times in a market cycle. Selling outperform assets, as we did with some of our REITs last week, and buying underperforming assets, which we are waiting to do at the moment, will continually add value and return. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform. This is how profitability is realized and the new cash reinvested. We also analyze each asset class to ensure that it is appropriate for each client's strategy. If an asset class, like the Canadian Preferred Share Index, attains a less than higher level of volatility, if it attains a higher level of volatility and becomes less suitable, which it has recently, we will reduce our and your exposure to continue to maximize risk-adjusted returns. On BNN's market call a few weeks back, Paul identified 3 top picks for our models. And I'm going to ask Paul if he has any updates for us on any of these 3 top picks.
Just a little bit better than when we spoke last week. So Athabasca bonds continue to move higher with the price of oil. So that's doing well. Plus, I should acknowledge as well that that bond, Scott, has just under an 8% cash yield that we collect every day. So that I believe is going to be a very low risk, impactful trade. Connexus, still no word on the closing of the purchase of Connexus by Superior Plus. That is waiting for regulatory approval, both Canada and U.S., and then the 30-year Government of Canada bonds. And we're about 7 basis points on side from our last purchase, which is good. So those 3 picks anyway seem to be working pretty well, and we still have some other impactful positions in our tactical portion, and we wait for them to unfold.
It is interesting as we talk about the tactical portfolio, because we're getting very little growth in the global equity portfolio given the state of markets. In fact, we look at the All World Country Index over the last year and even over the last 3 years, as we talked about earlier, we're not getting a significant amount of growth out of that. So having the tactical model in our portfolio is definitely adding value when in a time of very low returns, we're actually being able to pick up a little bit extra, which I think is great work, Paul, and thank you. All right, well, as we do each week, let's look and see what's coming over the course of the next week as far as important news or events. On well, tomorrow we have the Bank of Canada's interest rate decision. It'll be interesting to see what they say about the Fort McMurray fire situation. We also get a look at April's inflation data from the European Union. On Thursday, we're going to get a peek at the first quarter GDP for the UK. It's a bit of a historical situation, but nonetheless, we still need to get a handle on how the UK is performing, especially with the Brexit referendum hanging over their economic circumstances. On Friday, we're going to get a revision to the first quarter U.S. GDP, so not a big situation there either, but nonetheless interesting. And then next Monday is the U.S. Memorial Day holiday, and interestingly enough, the New Circles Charity Golf Tournament, which High Rock is a sponsor of. Anybody want to dig in and understand a little bit more about New Circles, which is a clothing bank that helps people in need? High Rock is taking a sponsorship position with them, and we do support them. So please feel free to have a look and see what's going on there. Next Tuesday, we'll get Canada's first quarter GDP, again a little bit late, but nonetheless still of interest to see where we are and how we're progressing. Of course, it won't include what has happened as a result of the Fort McMurray fires. And then the Fed's target price index, U.S. core PCE price index, next Tuesday, and then we'll follow up and close the day out with our weekly High Rock webinar. Well, that's it for today's discussion. We've managed to tidy it up and tighten it up so as to not take up too much time. And so that does open us up for a little bit of questions. If anybody has a question right now, please feel free to chime in.
Hey, Scott, if there are no questions, I do have one from a friend of mine who's a client of ours across the weekend that was just asking about our position in 30-year bonds, government bonds, and he's a fairly sophisticated guy, but he said, you know, if the Federal Reserve does start hiking up short-term interest rates, the overnight rate, do we think, you know, what's going to happen in the shape of the yield curve? You have a chart in there, I believe it might have been in the 30s, page slide 30-ish or 35, somewhere in there. But do we think 30-year yields are going to go higher or stay the same? and just the front end of the curve shifts up, and if so, why? So why we position that way? That was his question to us.
Well, you can answer that yourself too, but I'll put in my 2 cents worth just to start, and then you can fill in any gaps that I leave wide open. But really, what happens, and what we've seen historically, of course, is that when short-term interest rates are raised by the central banks, it tends to be perceived by long-term bond investors as an inflation-fighting situation. So in order to counter potential future inflation, the central banks are raising short-term interest rates. And that has historically benefited longer-term bondholders because, of course, their biggest concerns are inflation. So if you own a bond at 2% and inflation is going to 3%, then that's not going to be a good situation. If the central banks can control inflation by being ahead of the curve and raising short-term interest rates and nipping inflation in the bud before it impacts those longer-term maturities or the inflation scenario and then longer-term maturities, then I think it makes longer-term bond investors happy, and they'll end up actually doing more buying. So that's where we get that flattening of the yield curve. Now, it doesn't mean that there may not be some gyrations. If it's perceived that inflation is bigger and deeper a problem, then you may get the whole yield curve shifting higher initially, but as inflation is brought back under control, then that 30-year area starts to improve. I don't even see real, and I'm sure you don't, risks of higher inflation any time in the future. And therefore, I think there'd be a very positive impact on longer-term bonds, because if there's not really any inflation and yet interest rates in the short term are going higher, the likelihood of seeing inflation generated longer term is probably very limited.
Yeah, that's exactly what I told him, and then I just added as well, as per another graph I think that you have in the deck, that if the U.S. Federal Reserve does start raising interest rates here, and we get a flattening in the yield curve 2 years to 30 years, for instance, I think you show in your deck, that there is a chance that the Fed could be making a policy error. There is a chance that the unemployment rate crosses over that 36-month the 36-month jobless claims, and we get a recession. And if we do that, then we'll also get a big lift or boost in our 30-year bonds, as there's some sort of flight to quality or flight to safety as the economy moves to recession, and risk assets like stocks and the like are sold off. So I just added that as well.
Yeah, and I think that's to the benefit of our clients, that we are being better buyers of those 30-year bonds, because it represents protection for them too.
Yeah. Okay, thank you.
Yeah, thank you. Okay, well, we didn't get any client questions, but I know that if you are listening and you would prefer to send an email, we do want you to do that. We want to get feedback on these webinars. We want to know what you want us to cover if we're not covering all the things that you do want us to cover. But as always, thank you for taking the time to tune in. I know everybody's time is valuable, and we hope that we've been able to give you as quick and as much information as you need. Have an excellent rest of the week, great weekend, and don't forget to tune in next Tuesday. But until then, this is Scott Tomlinson signing off.